Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 30th of March. I'm Daniel Lam, your host for the podcast. In times like these, stressful environments, it is always useful to ask ourselves, what if the core scenario does not happen? What would this do to our key positions in the portfolios? Well, in the recent episodes, we've looked quite a bit at equities in regions and areas such as the US and China, as well as exploring the effects of the conflict in the Middle East has on gold as well as on other currencies. Well, today I would like to focus upon emerging market bonds, which we're overweight across both EM dollar government bonds and EM local currency bonds. Now, our core scenario is a relatively quick resolution in the Middle East crisis. What if the opposite does not happen? Well, EM central banks were ahead of the curve in the post-COVID inflation episode. But that does not mean they will automatically lead again. So the inflation shock was global, reflecting the deep integration of supply chains disrupted by the post-COVID reopening, as well as the war in Ukraine. Now, inflation was initially deemed transitory, but EM central banks began hiking roughly 8 months before the DM peers. Now, EM currencies had depreciated significantly, and central banks needed to raise rates to contain imported inflation. EM central banks have also spent many years building credibility and anchoring inflation expectations, which has made them more aggressive inflation fighters. But that does not mean EM central banks will automatically hike before the DM peers this time. So DM central banks have learned from the experience and are more likely to respond more aggressively, given the frequency of supply shocks and the fragility of inflation expectations. The global economy is not in the same place as in 2022, but investors should still be watching EM central banks closely for signs of what may come in the DM world. In both DMs and EMs, inflation expectations remain the key variable. Now, we do note the attractive yields in EM bonds compared to DM bonds. Within the EM space, we have a mixture of energy importers and energy exporters. Now, under the current environment, all else being equal, we would expect the inflationary pressure to be higher for the importers than for the exporters. And there will be differentiation in the bond performances between these two types of EM countries. Now, it is true that most EM economies have bolstered their fiscal and current accounts in recent years. The strong external balances and our expectation for a resumption of a weak US dollar trend should benefit external debt servicing. Nonetheless, in the near term, with the conflict in the Middle East and the weak risk sentiment, the dollar is likely to be staying on the stronger side of things. And this flight to safety mode would likely cap the performance of EM bonds in the near term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.